Residual market. In an uncompetitive market, insurance are free to select from among people applying for insurance. Those drivers, property owners, and commercial operations, they wish to ensure they do this by evaluating the risk involved through a process called underwriting. Applicants who are considered high risk may have difficulty obtaining insurance through the regular voluntary market channels. The term high risk applies to individuals in or individuals businesses with a poor loss record due to inadequate safety measures. Certain kinds of businesses or professions where the nature of the work is hazardous or where the risk of lawsuits is high, and specific locations where the risk of theft, vandalism, or survey storm damage is substantial. To make basic coverage more readily available to everyone who wants or needs insurance, especially insurance plans have been set up by set regulators working with the insurance industry. The businesses that insurers do not voluntarily assume is called the residual market. Residual market may also have been called shared because the profit and loss of each type of residual market are shared by all insurers in the state selling the type of insurance or involuntary because insurers do not choose to underwrite the businesses in contrast to the regular voluntary market. Residual market programs are really self-sufficient where the rates changed to high risk policy holders are to be low to support the program. Operations insurers are generally assessed to make up the difference. These additional costs are typically passed on all insurance customers. However, in a few states, insurers are not able to recoup their residual market losses, and political pressure prevent rates from rising to the level they should be. Actually, the number of drivers and properties insured in the residual market fluctuates. A law markers and regulators change law or address availability, rate adequacy, and of other factors that influence underwriting decisions. Automobiles residual market. The first of the residual market mechanisms for automobiles coverage was established in New Hampshire in 1938 as states began to pass law requiring drivers to furnish for proof of insurance having auto liability insurance because आज मैं लेना है वीडियो कंप्लीट करूँगा having auto liability insurance because a prerequisite for driving a car. Total all 50 states and the District of Columbia use one of the four systems to guarantee that auto insurance is available to those who need it. All four systems are commonly known as assigned risk plans. Although the term technically applies only to the first type of plan where each insurer, the team technically applies only the first type of plan where each insurer is required to assume its shares. or residual market polygones or risks. The term risk is used in the insurance industry to denote the poly insured as well as the chance of loss. Medical and insurance is also available through the residual market. Automobile insurance plans. The assigned risk plan, the most common type currently found in 42 states and the District of Columbia, generally is administered through an office created sport by the state and governed in the state. Began in April 2008. Yeah, वालेकुम सलाम. ठीक है
वीडियो बनाना बैठे तुम कॉपीराइट लग वैसे हकीकत है इन्हीं आवाज जैसे वीडियो अपलोड इन्हीं आवाज जैसे अपलोड है
गाड़ी दे दो
जी इनको खत्म कर दिया नहीं